The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome. Standard disclosures options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, myself, not investment advisors. We're not registered with the SEC nor Immerse, so please do reach out to a registered financial advisor if you do have questions about your own personal financial situation. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Yellow Tunnel and Tradespoon may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate various trade investment and trading portfolios. All right, guys. So, we've been going through a lot of market chop on the broad spectrum here. We've had some big movers, in the last few days, up on Friday, Monday, then back down on Tuesday. Today, a little bit of a muted move. I actually think that's probably a good thing for the market to have some smaller moves. Some smaller upside is going to allow for the bull to get a little bit more confidence, so we're not going to have that full liquidation. But ultimately, we've got non-farm payrolls Friday morning. We've got to get some fundamental economic data to really give people that confidence. So we're going into earnings season. We got non-farm payrolls. We'll see how all of that can impact the market. There's really no major person or investment theme in major control overall. There are individual stocks that look pretty promising. For example, I was looking at Citigroup, it's sitting at new highs. So there are names out there that seem to have a little bit more predictable potential movement, but we're in a fighting market, not a runaway market. The bull and the bear are fighting it out, duking it out, and the next data point may be the thing that turns the tides for everything, and we all just go higher. It may be the thing that turns into a liquidation mode. So it's kind of a wait and see market. Understand the chop and understand that the probability of success is frankly kind of a coin flip right now, and the return on capital is not as good for the buyer of options because the VIX is elevated. So in order to generate some good return on capital and probability of success, what we're looking for, or what I'm looking for right now, is ideas for names that are likely to either, chop in a range where I can look for something that is a collecting theta trade in case the VIX starts to come down or realized movement on the multiple day frame is nothing, or looking at short-term options that won't necessarily get hit if the VIX collapses 4% in case of a rally back to towards new highs, and the stock that decides not to participate in that case, or can really work out well if we get a fall in the market, a real liquidation where the VIX should spike up into the 30 range. So right now, there's a lot of benefits from using the option markets, but it can also be a little harder to find those really highly leveraged trades because the market is already pricing up the VIX a little bit. I think we need to keep that in mind. That generally means the expected value of the quote-unquote average trade is lower than when we have a predictable direction, easier to see direction for the broad market, and the VIX at lows. When the VIX is at lows, that return on capital becomes a little bit clearer. We got more leverage from those trades. And of course, when you got a grinding higher market, a standard trend higher or something like that, the probability of success definitely goes my way. And I'm just taking advantage of that defined risk and leverage of an outright options trade. If there are individual stocks you guys are looking at, always throw those in the question box. But, just as we go through, we'll take a look at things that are moving today and things that are setting up. So we don't really have a trend. Waiting 2-3 days to confirm a trend change is definitely key. I mean, we get these little blips, 2 days up, then a day or two down, 3 days down, then 1 day up. It's in this range. I wanted to find that range of where I start to get confidence that the market has confirmed a trend change. I'll look at it in particular in SPY and QQQ. IWM has some serious levels that can make it a little easier to confirm if a recovery is in place. And then going from that top down, looking at the big broad market, seeing how that's flowing through, and then knowing when that tailwind can benefit some of the other trade themes and trade ideas that are out there. So that's, the main crux of it. We've got an attempt in general to try to allow for more time by pushing the expiration one forward. When the VIX is elevated and going higher, allowing more time in long options trades can be okay still, as long as I see a higher potential move. So if I don't see the higher potential move and it's just the uncertainty in there, then I don't want to go out and buy March options or June options and pay an extra premium during uncertainty. I'd rather pay for it during certainty after a smaller move to the upside that allows for those options to maybe be priced similarly in terms of the actual cash outlay, but have the odds on in my favor. We've talked about chase and revenge trading. I think there's going to be a little bit of a concern about revenge trading today in some of these quantum computing stocks. NVIDIA is, whoever was at NVIDIA, I don't remember if it's a CEO or whatever, but he came out and said that quantum computing is still a long ways away. So that starts to hit stocks like RGTI today. Some of these names that had started to become really exciting over the last couple of weeks are going to get hit on that. Then we look for the market reaction. Where do we start to get that question of, is he right, or was the market right, or are the other analysts right on where the potential really is in quantum computing relative to artificial intelligence that's more now, or cryptocurrency that's more now, for those people looking for risk on kind of behavior. Yeah, that's good for that 10-year yield. So we pushed through 4.7. The high today was 4.72. Sitting right now at 4.69. This is not something that I love seeing in terms of getting market certainty on the direction. So yes, higher interest rates can be okay for the market. They can be bad for the market. They can be good for sectors. They can be bad for sectors. What is bad for the market, though, in my viewpoint, is we're in new territory and uncertain about where this 10-year yield can go if it continues to the upside. When I start looking at longer term charts, like a 2-year chart, we got a big level here around 4.7, and then the real big level's at 5%. Okay. So in the last 6 months, we haven't played around in this area. In the last year, we have. In the last year and a half, we've gone up as high as 5%. It can create a lot of, like I said, concern for the market that can elevate the VIX. It can create a lot more chop when we're going into new territory. If the 10-year yield can drop back towards 4.5% or even a little bit lower, get back into this range that we had from October 21st through December 18th, that we know now where interest rates really are. We're not worrying about as much inflation concerns. We're not worrying about some of that other stuff. Yeah, Wong, thank you. Quantum machines are, yeah. Thank you, Chuck, for the clarification on it. You've grabbed it on it. Just my mind a little scrambled at times here. I have, especially with everything going on with the fires in California. I'm not in California. Unfortunately, my parents' house is in the middle of the evacuation zone, and we'll see how that goes. But, I hope anybody else that's impacted by the fires in California is safe themselves, that their family and loved ones are safe. And, all we can do is just watch what nature does at this point and understand that it's out of our control, but it doesn't mean we're not going to worry. But in any case, below 4.5% is going to be I think a helpful thing for the market. And I actually, on the note of the fires, I think that that's going to have an impact on the stock market in other ways. There are going to be individual companies that are impacted, individual stocks, commodities that can be impacted by this. We got to watch that impact, because at the end of the day, natural disasters and things of this nature, they do impact the stock market. Obviously, they impact lives, but they also impact the investment themes that we may want to avoid at times, and look for opportunity to reduce the exposure on the financial side from that, and ultimately, I'm hoping for most people that the impact of the fires is mostly more financial and stress management rather than not being able to evacuate or anything like that. But yeah, as I mentioned, my parents are not at their house, so they're safe, and that's the most important thing. The property side of things, and I hope for most people is a manageable, albeit stressful experience. But those themes I think will become a little bit more evident over the course of today and into next week as people look to see how that impact will come through. So here on the 10-year yield is we are getting a close to a MACD crossover, and that could signify a pullback in the 10-year yield. So in the past, when we've had these runs on the yield, when we've had the MACD crossover, it's really been more of a period of consolidation that came out of it. And again, that's okay for the market, because as we see the market relax and get into a zone, it can allow the market to maneuver to the upside, consolidate, bring down option premium, and find opportunities in the market that are a bit more leveraged and a bit more easy to define that next potential move. Thank you, Ed and others, for the well wish, I guess, for everybody there as well. Let's check out Bitcoin. So when we're looking risk on, Bitcoin's obviously a big barometer for that. We had the breakout, or not the breakout, but the recovery to relatively highs. I mean, we had a 2-day window where we went above 104. Yesterday's highs. Yesterday, full pullback right back into the range. So more chop. For the moment, people are looking for opportunity. No, they wait again on Bitcoin. If we start to see some really aggressive buying of Bitcoin, it's going to be a better indicator to me that we are seeing risk on in the market. 6 figures is the key. Above 100,000, we start to wonder how high we can go. Pressing 102.5, that's going to be that next really big level to me. If we get above 102.5, that's been rejected a few times now, then we start to talk about 110 or higher. I'm not looking at this previous high as necessarily strong resistance of 108. 102.5 looks like the real key resistance to me for the Bitcoin market. On the downside, about $92,000 a coin. Below that, we start to get fear about liquidation, maybe back into the $75,000 Bitcoin range. That, I think, comes with a market liquidation. So if we're seeing the market falling and Bitcoin holds up, I'm not sure it will hold. I would not bet on it holding. If we see Bitcoin starting to liquidate, it may be a sign that people are looking for new avenues for portfolio growth, maybe a flight to safety instead of a flight to momentum, tech advancement, etc. For now, Bitcoin kind of in that range. And again, watching that range, looking for a signal that we've got something a little bit more firm for Bitcoin since really the election. See what time are we at. We are after the open, so we'll switch over here. Oops, I'm looking at eBay. Let me pull up SPY. We'll come back to eBay. They had a partnership with Meta that has really benefited them. So, speaking of stocks that are moving this morning, SPY, below 585 is a big level. We're just above it right now. That was the October high. That was the November low. Post-Fed, we dipped below down to 580. Or into the end of the year, we dipped below and went down to 580. So my first real key support here is 585. Breaking that, 580 becomes a minor support level. And then I look back towards, say, the September high, which we briefly went below at the end of October, 575 range. There's a lot of big support levels below the market right now, but those don't hold if it's driven by a fundamental input. So when the fundamentals tell people that it's risk off time, we get below 585. I think 575 is naturally in the cards in the coming days, and then see if that holds. 580 again will have some minor support. 585 looks more major to me, and that's my concern on the downside. On the upside, 600 is my resistance level. We towed it here in November. We tried it on the recovery at the end of December. We tried it at the beginning of the year, and we keep rejecting that level. We did have some time between 600 and 606, 607. But that, I guess up to 609 on the highs, but that's was only a couple of weeks. If we start getting above 600, I think the bull market starts to get really into effect for everybody, and we get a lot of confidence that above 600, we should have a small pause here in the 608, 609 range, but I think new highs are due. So we are in a relatively tight range to monitor here between 585 and 600. See how we do as we test the lows of the range, as we test the highs of the range. Eventually, we will break out. It may be today. That's all we can do is to watch on that one. Let's see here. So are the live trades as an option spread? So good question, Ed. The picks that we discuss here on the morning and closing bell are sort of our independent viewpoints on it. I will sometimes touch on some of the ideas that Vlad's looking at. He'll sometimes touch on the ideas that I'm looking at. The ones that are posted on Tradespoon are trades that Vlad is executing for his personal portfolio. But I talk through some of the ideas that I'm doing, and they just don't go into the like the Tradespoon live monitoring. So we're monitoring his executed trades on his account, and those things that you'll see on Discord or on the Tradespoon chat are from Vlad. All right. And for option spreads, I utilize a combination of either outright options or option spreads. For earnings season, we do a lot of spread type trades. Volatility moves very wildly on earnings. It'll collapse down from these elevated levels, pricing in that one fundamental event, and then collapse afterwards. So for those sort of scenarios, in order to mitigate some of the volatility-based risk, and rather than looking at expensive straddles or trades that have a lot of Vega exposure, we tried to look for spread-based trades at other times, especially when the VIX is low or individual option premium is low. We'll start looking at some outright options, whether they are more of an at-the-money, a little bit leveraged trade, buying an at-the-money call, or at times I look for those out-of-the-money calls for that explosive potential trade. When we've got stocks that have that meme stock style to them, the MSTR, the way it was behaving a month or two ago, or Rigetti, Rumble, some of these names that have started to get a little bit more parabolic, can be particularly interesting from the outright options perspective, because instead of having normal behavior, which is that when the market rallies, implied volatility falls, those trade the other way. As we're spiking, people panic buy calls, the implied volatility really spikes. And I can show you a good example, I think, with MSTR. Here on this chart, we see the implied volatility levels. It was about a 75 vol stock, which means moving around 5% per day was the expectation. As it started to rally, this implied volatility spiked to 220%. We started pricing in, 14% daily expected movement. Right now, we're back down to about 103 on the implied volatility. So the simple rough back of the napkin calculation is divided by 16, and that'll give me my expected percentage daily move. 103 divided by 16, it's about 6.5% that we're pricing in right now as expected movement in MSTR. So today's 1% move is nothing for now. There's a lot of chop here. Over the multi-day period, you can see that we've had a range from 290 up to 380 just over the last week and a half. So there's definitely movement, but on the whole, we're basically right where we were on December 27th. Very minimal change, and that's where that buying of an outright option instead of using a spread can actually really hurt. Paying a bunch of theta unless I'm trading it actively, buying into the dips, selling into the rallies. If I'm buying and then holding, looking for a trend, I'm not getting that right now in MSTR. All right. Yeah, and yes, I will come back to the broad market stuff for addressed. So, as I speak on the implied volatility here, you can see the VIX is touching near the highs of the last couple of weeks. We did not yet, of course, run back up like we did from the Fed. That would likely occur if we get a real market liquidation. It's not 5 days. I wanted to go 3 months. So we've had this range. When the market is calm, the VIX can drift back down towards 13 to 14% pretty easily, and that gives a lot of leverage to the market. When it's at 19%, the options are significantly more expensive. Increasing the premium outlay for an outright call option really helps lean towards those spread trades. The good news with that is that when spread trades look good and the market has no direction, I can look at put credit spreads or in the money call debit spreads. Those are going to collect some data and profit off of chop. If I do an iron condor, I have no directional bias. If I do a put credit spread, I'm basically just saying, well, even if the market keeps chopping, it shouldn't liquidate. And if it does, I've defined my risk. I never like selling outright options for obvious reasons because they have the risk of ruin. We have relatively undefined risk, and if you get market liquidation, it can wipe out an account. So defining the risk with a spread is significantly better for me in that case. I also like to look at SKUDEX, as I've mentioned before. In SKUDEX right now, this is the relative implied volatility in the puts for S&P 500 to the at-the-monies. It's staying fairly muted here. So a lot of the market really is looking at spread not coming up. Told me that people were likely looking at hedging portfolios by buying put debit spreads. That's not actually the way that I think the market probably should be behaving. I think the put credit spread makes a lot more sense as long as we can hold above our key support levels. And if the market does liquidate, an outright put is significantly better performer than a put spread. So the money flow right now, still saying defined risk to the downside. I can't say I necessarily agree with that philosophy, but that is where the opportunity can come in. I can look at a put credit spread, and the out of the money put that has not come up as much is then cheaper than the option that I'm buying is cheap on a relative basis to the at the money option, and allows me to collect a little bit more premium as a result for my trade. So that's kind of the broad SPY. Going over to tech, and this is where Tesla starts to kick in. It's very similar. We've got our main support right around where we're trading right now. If we look back to the November highs, okay, the next level of support is really around 500. So 3% fall. That can happen pretty quickly in a matter of a couple of days from random behavior. But again, we're looking for fundamental inputs that tell me that the market could liquidate aggressively here down towards that 500 level. And they're not today, it appears. SMH has been showing some chops, tried to break out on Monday, fully rejected it yesterday, down a little bit today. So again, range bound. And we'll just do small caps before I get into some individual names. Small caps, range bound. We've got defined downside here around 220 has been a big level for us, maybe a little bit below, I guess 219. So, we're about 0.5% away from the lows of the range, highs of the range, 226, far away from that. If we're going to stay in this range, this is kind of that spot to maybe nibble a little bit, looking towards selling at 226. If we break out to the upside, it sets up for a potential move back to the post-election highs, 240 range. So we've got a lot of little moves right now in preparation for the next big move. And, that's, again, where we're really at on this. Financials kind of holding up okay. The one that I had mentioned before, Citigroup, breaking out to new highs. Today we have an inside day. Still looks pretty positive to me as long as we stay above yesterday's low. But as it currently stands, we've just got a lot of random chop in this market. Let me pull up that Tesla trade here. So Tesla, we had the big rally. Well, really, so we had an election, gap, run, consolidate, broke out above 360, went to these new highs around 485, massive run. Natural to see some sort of consolidation or pullback after a run like that, going from $250 to basically doubling in the period of a month and a half. Gotten that pullback now, some profit taking, some shifting in portfolios. As long as we stay above, well, I mean, for me, 360 is a big level because that was our initial breakout. Okay, so getting above 360 was such a big point for then setting up this run. That I think that's going to be the biggest support. That's $40 away on the downside. There should be some support here around the 380 level. The test of the new year pullback slight here down towards 380. Kind of use that as a launching point on Friday. But we've got a bit of a ascending, or not ascending, just a wedge here. Let's see here. There we go. You can see that we're drifting down the highs, so we're getting lower highs, and now starting, at least on the short term, to create higher lows. So if we can hold this formation as this joint, that wedge, that can help define my next move. If we break out above this descending highs, then I start looking for a move back towards 465 to 485 range. If we break below 360, maybe 340, something in here, go back to this consolidation area. So we're not going to likely stay around 400 forever, but it could take market. Has a good size open interest on the 400 strike. It's not massive, but it's pretty big for Tesla here, with 26,000 puts open and 28,000 calls open. This is a big round number. It's a natural consolidation point, and that's what we're doing. It's using it as a magnet right now. So for now, 400 can be a big level. As we get away from it, it can create a launching point, a springboard element for the upside or to the downside, back to 360, up to 480. That's really looking at about a $60 move either direction. This straddle is priced at 30. If that springboard effect kicks in before expiration next Friday, week and a half, then this magnet effect continues for another week before we do decide to be priced at $30. That's what we're trying to determine right now for the market is, will this magnet hold for one more week? Because it's either it looks to me like we're either likely to pin 400 a week from now, or to push way away from it a week from now. And it's one of those coin flips. So either $30 is really worth closer to zero, or that $30 straddle is worth closer to 60. With a coin flip, it's either a double or a zero. It's a no expected really value trade until we get clarity from the technicals. So it's not a trade yet, but if we start to move, I start to look for that opportunity to pinpoint a move to 360 or pinpoint a move up towards 460. Okay? And that's just how I have to keep approaching this, is looking at it as something to monitor, but not something to trade yet. And with that in mind, I mean, some of the opportunities could be interesting in terms of, selling a 360, 355 put credit spread. It's not very much money. 60 cents for the $5 wide. If I paid $4.40 for the call spread, I'd be looking to generate about a 10% return over the next week. So it's not bad, but it's not generating significant leverage if we do 340. So for me right now, Tesla is a watch, but not necessarily a trade. I'm looking to see if I can get some clarity here. So it's the unfortunate nature of it, but that's an okay thing to have, is knowing that it's something good to watch, as opposed to something to get aggressive on. Getting into some of the other semiconductors, NVIDIA was a big story, looked really good on the open yesterday, and then fell right back into the range. So we rejected the breakout. Now we're chopping. Range here looks like 132 up to about 152. So 10 up, 10 down from here. It's about $8. On the high side, If we do get another move like yesterday, that could push us out of the range and start a breakout type scenario. So day to day, getting movement, week to week, not getting very much movement. Not necessarily something I'm looking to really expand upon a big position in NVIDIA. I'd rather wait to get above 150 again to get that confidence. So it's another one to monitor the range, look for the potential for a breakout, look for the potential for a move. But as it currently stands, nothing to get too excited about. All right. What else we got here on the stuff you guys are looking for? Let me pull up some of the movers for the morning. So let's see. Biggest mover right now is preparing for earnings on Friday. It's not a big move, but Jets down 1.8% today. That may be partially impacted by the fires. That's certain to create some, I guess, unknown travel plans for a lot of people. Probably a lot of flight cancellations and stuff, especially on the West Coast. Pulling back a little bit after testing the breakout. Delta is the earnings. So Delta has earnings Friday morning. And going through some of the earnings analysis here, you can see first off, this is that increase in implied volatility in preparation for earnings. This is a stock that'll be probably back into the 35% range for implied volatility post earnings. And on my earnings analysis, I can see that we're pricing in a roughly 6% move for earnings. Now, this is normally a stock that moves around 2.5%. In the last 2 years, the only move of 6% or more was 1 year ago. We moved 9%. If I look at the ranges, there should be some support right here around 58.25, about a 2.5% move, right in line with the normal realized move. There should be some resistance really around the 65 level. That could be up to a 7% move. And that's in line with the current implied volatility. I like what Vlad was putting through here, looking at a iron condor, expecting staying at least above this 57 level maybe, and staying below 65 can make a lot of sense here. So if I go completely symmetrical, staying below 65, and from here staying above 56, he had a simple 56, 55, I believe it was. Let me double check. He was looking at it with the, no, not that one. 55, 54, and 65, 66. So slightly asymmetric right now, but 55, 54 put spread, it's not a lot of money, but when you pair it with the call spread, it can increase the premium. You can't have both happen at the same time. We could have a collapse in Delta followed by a spike, and as long as the trade all gets exited as a package, that doesn't matter. But if you can't go below 55 and above 65 at the same time. The call spread right now is about 15 cents. The put spread is about 9 cents, so it's about 24 cents of credit. 24% of the max value. If we do have one of those big 10, 11, 12% moves, then risking 75 starts to hurt. If we only do our norm 2, 3, 4%, then I can collect a quarter. More often than not, we're probably going to stay in that range. Maybe it's a 10% chance that we break out to that move where it turns into a 75-cent loss. But if 10% of the time I'm going to lose 75 cents and 90% of the time I'm going to make 25 cents, that's a positive expected value. So in reality, this makes a lot of sense in terms of the expected value of the trade. Even if it has a higher risk than reward, it's the probability of success that makes this trade potentially work that much better. The other earnings that have some volume for Friday are Walgreens, and Walgreens is not something that I want to trade on earnings. We just have some randomness here with Walgreens that it doesn't make for great trading opportunities, especially in a $9 stock. And then STZ, Constellation Brands. Constellation's sitting on the lows. I'm not a huge fan of trading earnings when we're sitting on the extremes. So when we're testing these 6-month lows, There should be some around 210. That is a 4% move. That would be about in line with the last earnings cycle and about in line with the implied volatility. So there's no edge to me there. If we are to get a normal move based upon the last 2 years, it's about 2%. That only goes up to about 222.5 to really trade much with the options and to express a view, especially given that yesterday alone, our range was $8. So we got a almost 4% range without earnings. I don't see a real purpose in trading for a 2% move on earnings when the market's really just not pricing in that much aggressive movement. So we just got to move on from those ones and get ready for the bigger earnings that are going to start up next week. We can look at it. In reality, non-farm payrolls may have a bigger impact than earnings for a lot of these stocks, just since they can be a bigger input. But we do have KB Homes starting up the home builders next week. We've got what are the other ones that are big? JP getting into the banks on Wednesday. And that's going to be, I think, a lot more impactful and a lot better tradable opportunity is meat and bones of the market, seeing where we're going with our wide financial markets, our current economic conditions, considering whether we're going to have recession risk, inflation risk, et cetera, and how that is impacting corporate earnings. Okay. Let's see here. What else we got moving here? So Jets was one of the bigger down moves. TAN, a little bit of profit taking in the solar field here. So solar has been running really since the start of the year. January 2nd, started putting some money into solar, ran for the week today, getting a little bit of a pullback. This is not bearish, but I'd look for a bull flag here. Higher high and a higher low on Friday, start setting up the next leg. The big boys are First Solar. That's one of the most traded solar names. Sunrun, another big one here to watch. And they're all kind of doing the same thing. Starting up, coming off of the floor, there's going to be a natural seller looking to just take some money off the table after winning for 4 days in a sector that is uncertain, unclear to the upside. And it seems like that's what we're doing right now. Solar Edge, another one to monitor here as it tested the 100-day moving average and so far has rejected that. But I'm looking for bull flag setups here in order to generate that next potential leg higher. As it stands, though, again, today is not a day to add that trade for me. Apple is starting to get a little bit weaker here. This has been a bit concerning since the start of the year. We had the pullback, a little bit more negative commentary on Apple, iPhone sales, etc. There's a bit of concern here. It is part of the flight to safety for tech. So they do still have a lot of technological advances, but they are one of the quote unquote safe tech plays. When I'm looking for a big momentum, risky or safe play, I may be in artificial intelligence stocks like AI or Palantir, or go into crypto with MSTR. But when I'm looking for something that seems a little bit safer in the tech space, Apple is where the money tends to go. Now, this is also, I think it's like 8% of QQQ. So when Apple moves, it can set the tone for QQQ on its own. So we have to have that in mind because it can set the tailwind or the resistance for the broad market. When Apple is moving a lot, especially on a risky point, an inflection point for QQQ, it can cause liquidation in other names. So I got to be a little bit concerned about Apple not finding really major support here. We should have some at 237, about another 1.5% away. But if we get down there, potentially cause QQQ to pull back down a bit more again and potentially create other liquidation in other names. So right now, Apple is something I'm watching, but not, again, looking at aggressively trading. So I started to touch on Citigroup. I want to address how I'm looking at this for a short-term trade. So we broke out, and right now we are starting to fail at that level. If we can't bounce back up take back about half of today's fall, I'm not sure that I would want to do this. After all, look at the end of the day for the trading is a good strategy here for Citigroup. If the market starts to bounce back and Citigroup can get back above 73 and a quarter, then I look for a very short-term trade. It is going to have earnings premium built into it, but buying a 70 at the money, looking for a run up into earnings. I don't want to hold it into earnings. I want to be out before earnings because I don't want to be subjecting myself to the unknown, even though it's normally about 2%. What if we get a 4.5 or a 5% fall? And this is based upon some technicals and some positioning ahead of the earnings, looking for people that are trying to buy the stock ahead of earnings to get ahead of that potential move. So as long as we get a little bit of a rally here, and we're starting to get it right now, whatever the dime that we just moved, at the end of the day, a $73 call could be actually a very interesting strategy for just a short-term hold, through the end of the day, Friday, maybe through the end of the day on Tuesday, but not holding it through earnings on Wednesday. And I don't bother with a spread in that scenario because I don't see implied volatility in Citigroup falling ahead of earnings. It just seems unlikely. And with a short holding period, I can simplify this down to a single directional trade and then not be completely prone to implied volatility collapse. Yeah, how about oil trades? That's a good idea, Bruce. So let's flip over there. So we'll start with USO. Big run to start the year. A new potential thematic trade for people, clearly. We ran into the end of the year, jumped on January 2nd, sitting near the highs, generating some interest and excitement potentially for the energy names. XLE ran a little bit, but clearly underperforming flat oil prices. And of course, that's natural that there are going to be some divergences between the two. We're not going to have them go lockstep. Oil prices high can be beneficial to some oil companies and it can be bad for others. They've got to get their margin. That's the big key, right? But I do like the way XLE is forming here. We did the run. We didn't have any major pullbacks. Doesn't look like there's anybody that's needing to get out of energy as they probably already did. They spent the entire month of December liquidating all energy companies. Shouldn't be a lot of major holding in there that is looking to liquidate. Occidental is one that I always like because Warren Buffett continues to buy it. So as long as he's buying and buying on dips, that means that he's not getting out and constantly said he was still buying here in December. That's a good sign for Occidental. We are testing a good resistance point here. We got the 100-day moving average. We've got $51, $52 towards 56, 57. In the options market, that can be expressed via spread trade. We've got earnings on February 18th. So maybe I hold with February 14th options. These names don't normally have huge moves on earnings, but why put that risk on myself anyway? Taking a weekly option, targeting 56 via a 52-56 call spread. Right now, it's about trading just over 25% of the maximum value. That gives me some decent leverage if we do get that breakout. The nice thing is that call spread should only move a little bit on a push, even though it's a dollar. The delta of that call spread, the delta of that call spread right now is, so even if it goes to $1.30, that's not the max value that I'm giving up. I'm the max value that I'm giving up. I'm now buying in at about 33% of the max value instead of 25% of the max value, but with confidence that we can make that push towards 56. As it currently looks, if I were to buy now and we just reject this high, which kind of a coin flip on whether we're going to reject the resistance or reject the breakout and pull back, or if we're going to actually break out, I'm reducing my odds of success, even though I'm increasing my return on capital. So I want that probability of success a little bit higher with that confirmed move above 52. And then I look at that 52-56 call spread for a potential leveraged move there. I should touch on XOM, because I know that was one that Vlad's looked at as well. And, XOM underperforming XLE right now. It's one of the big boys, ExxonMobil, and it's just, this is a bit concerning for me for ExxonMobil. It might be a situation where generally I just say it should stay above the previous lows, 105. And I tend to shorten my trade time frame when I'm looking at a credit spread, upward credit spread, or an in-the-money call debit spread. But here we can see like a 102, 105 call spread is trading around 440, put credit spread around 60 cents. So it's back to that idea, or sorry, not 440, excuse me, 240. So looking at a potential for about a 20-25% return, buying the 102, 105 call spread, as long as oil companies don't go back into liquidation mode. And if oil prices stay up here, I don't see the need or the justification to liquidate what's already been liquidated. So I think for ExxonMobil, this goes back to that spread trade idea, looking for it to hold support and see where we go from there. And if we break through support, I got to look at the exit on that trade and say, technically, we can go back into liquidation. Angelique, the trade on the 73 calls. Yeah, so where I'm looking is the 73 calls, maybe the 74s. They're about $1.80 right now on the 73s. The 74s are $1.30. They should perform relatively similarly. There's about the same amount of theta for both of them. There's not a huge differential in terms of the performance, other than if you want a little bit of higher delta, the 73 calls are slightly higher delta, 55 delta. The 74s are about a 45 delta. So for every dollar moved to the upside in Citigroup, the 73 calls force by about 45 cents. So it doesn't matter as much in a short-term trade like this for a couple of days that we don't run aggressively through my long strike. When I'm looking for a longer term hold, I have to go through my long strike to make sure that, or away from my long strike to make sure that I get that move towards the intrinsic value instead of that time premium. But the time premium shouldn't decay too much as we're going into earnings, because most of the time premium for the next week options is really about the earnings at this point. All right. A couple of others that have been popping up in the energy sector. Chevron looks particularly strong today. So we've had the run, and today testing the highs. And Chevron looks to me like a 162 type target point here. Get up towards this 160 to 164 range, retest this the highs of November. So if we're going to completely unwind this liquidation from December, that would be a natural landing spot over time. First means we were likely to not quite reach that target point. But if I can go with let's see here. If I can even get to 156 ahead of earnings, that would be pretty solid. I could look at a 155 call, but if all we do is go to 156, I barely make any money. Those go from 90 cents to $1. The 152.5 calls just generally give me a lot better probability of success, give me something a little closer to at the money. If we underperform and go to 155, I'm still making a good return, 80 cents on a $1.70 investment, roughly 50%, just under. If we go all the way to 156, now these are worth $3.50 and I've doubled my money. The 155s wouldn't perform quite as well. I could argue for doing the call spread, or I could argue for just buying the call. There's not a huge, a huge slam dunk. Yeah, I'd much rather buy the call than the call spread. But for me, I think that those are kind of the ways that I'm looking at CBX. And part of it has to come back to how I would manage the trade. If I'm exiting at 155, no matter what, I might as well do the call spread, because then on the failed trade, I've reduced some of my loss. If I'm exiting at 155 now, is my plan, but I might hold through. Then buying the 152.5 call gives me that optionality for more leverage to the upside, even if as it's running. So, it's part of the trade plan idea, setting the plan, setting the target price, and knowing exactly how I want to handle it if it gets there. I can cap my upside if I know I'm going to sell. I don't want to cap my upside if I think I would potentially want to let it run to 160 or higher. Okay. So that's Chevron for you there. More of a stock-based trade that could be interesting. Transocean going offshore drillers. We are seeing a nice run here in the offshore drilling. And there was some commentary yesterday out of Trump talking about making sure offshore drillers are given their freedom to continue their operations and everything. And that could be a big benefit from the political side for Transocean. The one that was really moving yesterday was Scorpio tankers. So these have been just a downtrodden sector, these oil tanker companies. Scorpio has dropped from, over the last 6 months, very bad. Starting in May, near highs at 83.5, we drifted all the way back down to 46. So down almost, 40 in July of 23. And if we're just getting started on this, there's not a ton of natural resistance until we get towards $65 a share. A little bit of consolidation occurred here in the 55 range. But frankly, if we start to move and people start to buy into these tanker companies, Scorpio looks like it's a big potential runner here. And, implied volatility, it's a little high, but it's not crazy. I don't think earnings is going to necessarily be the driver of this potential move. If it wants to become a thematic type trade for me, I think looking at just some outright calls with a little bit more time, maybe going all the way out to April, the $55 calls for $3.50. I could reduce my expense a little bit by going into a 55.60 at $2.30 for the $10 wide call spread, targeting a move back to 65. The lows of this, October area, that could be a pretty significant leveraged return. So I'm thinking in terms of a trade plan here, that if I decide to go just one on my list, I haven't decided yet if I'm going to go into it, but I'm thinking it's starting to look attractive, especially if we can hold here above the 50-day moving average and start prep for that next leg higher. That April 55.65 call spread looks like a decently leveraged trade to give myself time for this trade to work out. If you want something more like a stock trade, I used to be a market maker in Nordic American Tankers. They're, obviously a Norwegian-based tanker company. This used to be, let's see if we can't even get to the time. Let's go to all. So you can see this used to be about a $25 stock. When I was trading it as a market maker, was actually before, let me think here. It was in 2000. Yeah, it was actually before 2011. So we only go back 14 years, I guess. But the year back before 2011, it was like a $50 stock. Obviously, things have changed for the company. It has not performed particularly well over the last decade plus. But if this could even get back towards $10, it's just kind of an interesting company to trade, but it's a stock trade. There's no value really in trading $3 calls and $3.50 calls in this stock, knowing that reality is it's probably in the bull case going to $3.50. But it could be a stock trade for those looking for that kind of idea and just saying as long as it stays above 2.5, 245. There's clearly some buying out there. So I've got a good stop down at 245. And then I can just kind of let it run and then manage the trade as the technical formation shifts over time. So I always like going back to it. I don't know why. I always want it to be bullish, maybe because, and I know it's psychologically because I used to be the market maker in it. And I hate seeing those stocks I used to trade go to zero, but it just could be an interesting one to look at if you're looking for something else within the sector along with STNG. Individual names moving today. The big one is eBay. So eBay has a partnership with Meta and broke out. For now, the new support level is going to be the previous high. We're spiking. I hate playing around with these ones after they've moved like this. It's either, being in it ahead of time or waiting for a clear technical formation afterwards. It almost acts like an earnings move. We now need to see how the market's going to continue to digest this information, process the information. But for a bull, I think as long as we stay above 67, I think it's 67.80. Yeah, 67 here. If we start to get back down towards 67.80, then we're just back to the range. But I don't think that, I don't think we'll go back down there. But if the market decides that we have to go back down there, there's got to be a reason. And then I don't want to be necessarily just running with the long that no longer seems to have any real value to it. So if you've got eBay, trailing stop, or maybe even just booking some profits here, taking the money and running, we're at a nice elevated point here. Just overall nice size move there. And I got to pull it up. So Boston Scientific, I don't know about Boston Scientific. We were starting to get the breakout, and then today the gap higher in Boston Scientific. So good call for, might have been Bob, talking about Boston Scientific. Maybe it was, I don't know if it might have been Ted, but in any case, looking at Boston Scientific yesterday, we started looking at it, potential for that breakout as it tested the highs. And then today we get a nice 5% move. So, that's why we watch some of these key levels. We had some accumulation in Boston Scientific, and it tells us why. As much as I, hate the fact that it's true, people know what's coming. Maybe not a lot of them, but some people know what's coming, and they start to accumulate positions ahead of these gaps many a time. And so that's what part of why we look for this technical formation is something was brewing that allowed for somebody to start saying that they were confident in building up a bit more of a position to take advantage of this 5% jump higher. Lo and behold, here we are. Medtronic, another nice move here. Also healthcare, and that one did not look like it had any signs of knowing that it was today, but this is an easier potential trade, I think, for targeting a resistance point. $84, 84 to 85 should have some resistance. So at this point, we're already halfway there, $2.50 on an $82.50 stock. Just doesn't get me that excited. So not necessarily looking for anything aggressive there. Okay, AIG insurance. I don't know how big their exposure is to fire insurance. Most people in California are also from their particular insurance that was causing them to get hit today. And people don't like dollar stores today. Dollar General breaking down to new lows. Dollar Tree breaking down to from here as well, and not to the new lows, but getting dragged down. Dollar General clearly the worst of the discount retailers. And this actually sets up a potential for an outright long put. So with Dollar General, implied volatility at 36.5%, that's not low. It gets down towards 30%, but it's not high given the potential for more major liquidation. We had a big fall and then a kind of drift lower before this earnings, and now just drifting back down to low of the range. We've had a lot of consolidation, but if there's something wrong at Dollar General causing a 4% drop today, this could be an interesting March 13th to cause any sort of concern there. But just like a February 70 put for $3, if we continue these kind of falls, that can really spike up a lot pretty quickly. So, Goldman downgraded AIG. That would be why. Thank you, Fred. So AIG getting the downgrade. The inverse of Bank of America upgraded Citigroup. Now Goldman downgrading AIG. Yeah, I mean that's looking a little dangerous here as we test the lows. This should be an interesting formation coming out of it, though. If we can't push lower after the downgrade, and we start to set up a bounce back recovery towards $73, this is certainly something that I would look towards a spread trade. With 70 support, if I wanted to be in now, a 68.70 call spread for about $1.40, about $1.40, that's got a potential for nearly 40% return, as long as we hold above the key support. So the pressure's on right now. There is certainly some risk there. There's no guarantees that we're going to hold above 70. But if this support that is held before, the low from December, and really back here in August with a short-term dip below after non-farm payrolls, if that can hold one more time, that's a pretty good setup for me, actually. If I see some volume without a break, that would be a nice big starting point to it. So we had some volume here without breaking. So some buyers definitely showing up at $70 again. If I give this a little bit of time and we continue to stay above 70, I do like that next week 68.70 call spread as a way to define risk with a potential for a 30-40% type return. So we'll see how that plays out, though. It doesn't look like a bullish stock by any means. It's just about, have we gone far enough to the down? All right, running up on the end of time here on this. If there are any other stocks you guys are looking at, I'm happy to pull them up here. Palantir continuing week, so the AI exodus is continuing. I call it an exodus. I mean, it's a pullback now. It's not just a dip, but it's getting to be a bit more concerning as Palantir now presses towards the 50-day moving average, looking for support levels. Maybe it's around 61. These ones didn't hold. So, for now, doesn't look great on the AI side of things. Doesn't look great on the Bitcoin side of things. So when the aggressive tech, I think that'll be more exciting. But for now, we are what we are on it. We're just watching some of these names for a clearer move. But it seems like the downside is definitely at risk in the short term. And again, can be completely flipped out with a good non-farm payroll number on Friday. So we'll see how that plays out. Even Micron falling today. My old nemesis, for those of you that remember, I was playing this on the bull side and then it just completely collapsed from, what was that? I think it was right around back here. I was looking at buying in the, might have been, was it in July? No, I think actually, sorry, God, I'd have to look back on it and double check, but it may have been off of actually a recovery. No, it was before that. So might have been a falling point here in July, then started to recover back in August and then failed again and had to gap up on earnings. And that's where I actually made decent money, was buying in for the earnings in September. But that was just offsetting some other, probably poor trading on it on my part, where I was fighting against the, we all make mistakes on it, and just reevaluating afterwards and doing the reviewing the game tape. Always helpful, and remembering not to try to fight the market when it's got a trend down. It doesn't mean it's going to turn around yet. You got to wait for the right signals. So, yeah. All right. So if there aren't any other questions, I will let you guys get back to it. Remember, we don't have a market tomorrow. So we've got the market closed for Jimmy Carter. But I'll be back on Friday for the close. Really positive sign starting here, seeing Apple bouncing back. So people are looking for something in tech to buy potentially, and just going back to their safe haven of Apple in the tech space. Maybe. We'll see how that goes. Of general tech flows that we'll see if it continues. All right. With that, I'll let you guys go. I'll see you on Friday. Have a great afternoon.